You guys legit blow my mind. The number of you that have been watching what's going on in the markets, following it, asking amazing questions. Also, yes, my tongue is bright green because I just ate spinach. I had no idea it turned your tongue green. Anyway, if you watched my last video, I didn't explain what short selling is, and a lot of you were like, hey, can you make a super simple video that actually explains what short selling is? And hopefully it'll help you understand why stock prices like GameStop, AMC, BlackBerry are skyrocketing as a result of short selling. So this is what a short sale is. Essentially what you're doing at the most understandable level is betting against the price of a stock. So you think a company stock is going to go down, you enter into what's called a short sale. Here's how this works. I, as an individual investor, can go to my broker dealer, which is Schwab, whoever your brokerage is online. Just like you can go to a bank and borrow money, you can go to your broker dealer and borrow shares of a company. Mid-December, I see the stock price of GameStop is at $20 a share. I think that's extremely high, and I think it's gonna drop in the next few days or weeks or month, maybe a couple months. But anyway, I want to short sell this stock. So what I do is I go to my broker dealer and say, hey, today GameStop is $20 a share. I would like to borrow 10 shares of GameStop. My broker dealer says, okay, that's fine. You need to open a margin account and have the minimum margin requirement, which is at least 25% of whatever I'm borrowing in my account. So fine, put the cash in. They say, okay, great, we'll give you the shares. You can borrow the shares from us. Yes, with a margin account, you do have to pay interest back to the lender. So that's how they make money on this. So now into the short sale. This is how it works. I borrowed those shares from my broker dealer. I turn around that same day while the price is still high, go out and sell it on the open market to someone who wants to buy those shares. And now I'm left with cash. I hold on to that cash because I think next week the stock price is going to decrease. So for the sake of example, let's say it's a few days later, the stock price drops to $10. Woohoo! I go out on the open market now, buy 10 shares for $10 per share, return it to the original broker dealer, the lender. Clarify, return the shares to the broker dealer, because honestly, they're probably not even the broker dealer's shares. They probably borrowed them through securities lending, which means they need those shares to give the shares back to whoever had them in the first place. It's very important you understand that it's the shares that they need in return, not just the money. Woohoo! I go out on the open market now, buy 10 shares for $10 per share, return it to the original broker dealer, the lender, close out my margin account, I'm done, and I made $10 per share simply because the stock price dropped, because I borrowed it, sold it to somebody else while the price was high, rebought it when the price was low, and then returned it to the lender at that price. So that's how you can make a lot of money really quickly if you short sell and you think the company's stock price is going to go down in the near future. And from what I understand, with a margin account like this, you don't have to give the shares back within any specific time frame. So I can just keep waiting and waiting for the stock price to keep going lower and lower, eventually rebuy them and return them to the lender. As long as I'm meeting the minimum margin requirement, which is whatever the percent in our contract, and I'm paying the interest in my contract. So now let's understand what happened in the case of all these short sellers and GameStop. So individual retail investors and the Reddit investor community realized they could look at companies that had really high short shares, like a lot of people who were short selling the stock, and GameStop had over 100% of their trading volumes short shares at a certain point in time. So these Reddit investors realized if they started coming together and buying the stock, GameStop for example, the price was going to go up. The more people who buy a stock, the higher the price goes. So they come together, they start buying GameStop. The price starts going up a lot. Well, all these short sellers realize, okay, we have to cover our shorts. We have to repay our lenders, give the shares back, and we also have to meet these high margin requirements in our accounts. And if the stock price is going up a lot, so is their margin requirement. So they have to start going on the open market and buying shares to repay their lenders, which causes the stock price to go up even more, because now we have all these individual retail investors buying the stocks, plus all the short sellers closing out their positions, buying shares on the open market and returning it to lenders. So that pushes the stock prices up even higher. So that's what's called a short squeeze. The short sellers get squeezed when the stock price starts going up, and they realize that they have to start buying it even though it went went up, cut their losses, return it to the lenders, and get out. Well, there's another mechanism at play here, and that's called a forced closure. So I mentioned how there's not really a specific date where you have to return the shares to the lender, right? But you do have to constantly meet that margin requirement and pay interest. So technically, if all these hedge funds could just easily meet their margin requirement, they could just hold their positions and wait until the stock went back down and hopefully have fewer losses. Well, when the stock price goes up an insane amount, first of all, they can't even cover their margins. Second of all, the lender realizes these short sellers, they're never going to be able to afford the stock at the price that it is now, and we need those shares back. They probably went through securities lending, and it's somebody else's they have to give it back to. So it's usually in most margin contracts, but it says that that broker dealer can close that account, put a margin call in the account for the amount of the shares that they are due, and force the short seller to repay them. So I can't say for certain whether or not that was happening in this scenario, but my guess is yes. If someone like Melvin Capital is closing out their position with billions and billions in losses, that means they were probably forced to go buy those shares and repay the lenders. And when that happens, the stock price gets driven up even more. So at first you had the retail investors buying the shares, then you had the short squeeze, all the short sellers having to come in, buy and repay the lenders, pushed it up even more. Add the forced closures on top of that. That's why these stocks are going up from $20 a share to $450 a share. Insane, insane, insane. So I hope that was helpful and clarified a little bit what short selling is. Let me know if you have questions and what topic you want to see next. Go make money.